Good morning, it's Mike. This is Market Insights with Mike on Friday, May the 7th. Mallory is our producer, our editor, and our technical person behind that big blue first option bank curtain. So we had a really interesting week. It's kind of fun when we do this. Some weeks we don't get any questions at all. And then we have weeks like last Friday where I spent most of the rest of the day and well past 5 o'clock fielding one specific item, and that's inflation. A big popular topic for today. It's been a popular topic for a couple of maybe 10, 12 days. It just seems to be a little bit of a steamroller going on. So we're going to spend a little bit of time on inflation and what that number is that we threw out that the Fed looks at when they talk about inflation, because it's a little bit different than what you and I look at. So Mallory, let's go ahead and start with that and get right into it. And then we'll get to our regular slides. But inflation, what they refer to is what's called core inflation. There's a difference. A couple of years back, I can't remember exactly the year, but they took food and energy out of the inflation numbers. And the reasons, they had two primary reasons. One is that the prices are so volatile in food and energy. And the second reason is demand is basically inelastic, meaning that very rarely are you going to not buy food because of the price. And if you work and you've got to go places, you got to get around, you got to heat your house, the price of energy, the price of gas isn't going to change your habits a lot. So that really is going to affect what decisions you make. And those decisions basically are probably not going to be anything more than grumble about the price. So they've removed food and energy from the calculations for what's called core inflation. So when we're talking about the Fed wanting inflation to be at 2%, that doesn't include food and energy changes. And we're going to talk about that in a second. So let's go to the next one. The consumer price index is where you're going to see most of the issues with food, transportation, and then obviously medical care. When I first started doing this, which was well over 23, 24 years ago, our medical care, when we would do a budget, our medical care was about 7% of a budget. Today, on an elderly couple, that medical care cost could be as much as 25 to 30%. It's frightening how much that's grown. I remember an advertisement, and it wasn't that long ago, it was 5, 6 years ago, where a pretty big insurance provider was advertising in November, December, that they promised that you would not see an increase next year greater than 9%. And the part that really bothered me about that is they felt that promising an increase of 9% over the next 12 months was a positive thing, when at the time, people were getting 2.5% raises on their checks. So what they meant is, we're going to grow and we're going to take more of your check, but aren't we great for keeping it at 9%? Medical care costs has grown incredibly as far as what we're concerned. And you got transportation and food. So CPI is a measure of prices of a basket of consumer goods and services. So what we're going to do next is we're going to talk about CPI history. You go back to see where it says 1982, where it was established at 100, or basically par. And then you can see inflation basically means up or down. So you can see in 2018, it went from 182 up to 251.1 in 18. A pretty big jump. And then you go back to 1930, where it dropped 16.7. Obviously, that was because of the Great Depression. And then 1940 was still recovering from all of that. It was still recovering. So what we had there was deflation. And then you've had this growth on the CPI, Consumer Price Index. So that's what we're seeing. So you kind of thinking to yourself, where were we in 2000? You got to remember 2000 is when we were all worried about what computers would do when they came over the new millennium. And we were at 172, now we're at 251, significant increase in consumer price index. So that is kind of separate from the core inflation that the Fed talks about. This is a chart showing CPI, Consumer Price Index, back to December of 19. So we're only talking a little bit of time here. And you can see, obviously, the blue is an increase, the orange is a decrease or deflation. And it shows kind of how that's gone around. Now, that looks like a pretty big swing. But the fact is that one line there is 0. That's nothing changes, everything's the same. And your lowest, it only went down, not quite 1%, and the highest up 1.5%. So people get a little concerned, but I think we kind of focus on those prices maybe a little bit too much. The change is not bad at all when you're looking at from December 19 to December 20. So you're talking, a good solid period of time. And it really only fluctuated from 0.20 to 0.40 with that dip of almost 1% in the middle. So it looks volatile, but it's really not too bad. Then we want to go to the next slide, and we're going to see inflation factors. So these are the things I talked about where you have all the items. It's just a little bit above about 2.1, 2.2%. And then you have food, and obviously you can see that's grown more than basically core inflation. Purple is energy. Look what that's done in the last 12 months. It's not really a surprise. And then on the far right, that's what we call core inflation. That's what the Fed talks about. So there's a huge difference between what they call inflation and what you and I call inflation. Now, before we get too far into that and get too upset about this, you got to remember that 20 years from now, when our kids and our grandkids are studying economics, they're going to study 2020 because 2020 is going to be a watershed year as far as studying economics is concerned. You look at the price of energy, yes, that's high. You look at the price of food, and what bothers me there is that the price has gone up, but really in our pocket, we're spending more at the grocery store than we are eating out. So the price of food has gone up, but our spending on food has gone down. And it's gone down because 2020 and the pandemic kept us from going out. I heard a conversation yesterday on the radio. They were talking about alcohol sales. Alcohol sales are through the roof, but the dollars spent on alcohol are severely diminished. And the reason is that if you go out to a restaurant and you order a drink, you're getting one drink out of a bottle of liquor. At home, you're going to get 27 drinks and spend about $8. At the restaurant, you're going to spend $8 for one drink. So we're drinking more, we're eating more, but we're buying it more efficiently. So that's kind of my problem right now with worrying about inflation. It's how we're spending it and going forward, how we adapt to that. I think that, as I said, 2020 is going to be a watershed moment in economic study. And someday our kids and our grandkids are going to be studying that on how the economy changed between prior to 2019 and then 2021 forward. And the 220 is this wall where things just kind of adjusted and moved around. So yes, we have some items that have grown a lot, and that bugs us. So I put together the monthly basket, and I used the same number for these. I estimated pounds of chicken, I estimated loaves of bread, but I use the same thing. I estimated kilowatt hours, but I use the same thing for every period of time. So in March of 2001, to get this basket of goods would have cost $200.57. Keep in mind that next to the bottom line, that kilowatt hour, that's heating your home. And then as you go forward, the same basket, the same amount of goods, the same weight on the chicken, the same loaves of bread, the same pounds of bananas, which haven't changed much in themselves. So now in March 2021, what was $200.57 in March of 01, 20 years later is $340.51. Is that horrible? It's really not. It's typical. And you can see that next to the bottom line, that is period versus period. So from March of 01 to March of 07, it went up 52.4%. And then March of 7 to 11, it went up 26.3%. The cumulative change goes back to March of 1. So it's been a 69.8% increase in that basket of goods from March of 01 to March of 2021. We would tell you that rule of 7.2, things double about every 10 years. This is a 20-year period, so this basket of goods is not too bad. Now, that's been overweighted by, bananas are basically the same price. Bread isn't too bad at all. Chicken's not too bad at all. Milk is the big one. That's extremely volatile. Kilowatt hours went from 9 cents to 9 cents a kilowatt hour to 14. That's not that bad. Gasoline is another big one. It's the volatile. So I've included some volatile items in there, but my point is I don't want anybody to start panicking about inflation yet because, yeah, we're going up, but we're not going up. It's something that's unreal, that's not acceptable. So those are the differences in core inflation and you and I inflation. The core inflation is what the government looks at, and real inflation is what you and I feel in our own pocketbooks. So let's talk about the recession for a second. There's a group called the Business Cycle Data Committee. Inside that group, it's the National Bureau of Economic Research, NBER. They're the ones that are the official arbiter of recessions. They determine when they started, when they ended. And as I've said before in economics, what economists tend to do generally is they can tell you why something happened. They can't tell you why it's happening usually, but they can always look back and tell you why it's going to happen. So the dating committee still has not officially determined that we're out of a recession, although the consensus is we probably are. Their hesitation before Enber determines what that date is, their hesitation is probably in the fact that they're going to have to declare the recession lasted about 30 days. It may have been the shortest recession in history. Obviously, they're waiting on employment. We'll talk about that in a second. But that may be what the issue is. Once they date this, and they're probably going to date it sometime in late April, early May of 2020, that the recession officially ended. That's how quick the recovery is. It would have been the shortest recession on record. It would have been the quickest recovery on record. So we're still waiting for them to come up with the date. Generally, the consensus is we're comfortably away from the recession. The market's growing. We are up. Golly, we've gone from 30,606 on the Dow to 34,548 in 86 trading days. And if you annualize that, that gives us a return of comfortably over 30% for the year. That's a strong market. That's strong growth. That indicates that there are a lot of good numbers out there. So let's go on to the next one. Now, our Dow Jones average, you can see that we've started to see we had a couple of flat times. And here we have a little breakout going on. The Dow closed yesterday at 34,548. Good number, still going up. And you don't see really any issue that we should be worried about. It still shows that we have a strong economy. And for me, for what I'm looking at is the average daily movement. And the numbers I just gave you, the average daily movement over every 6 days is still very positive. So we do pay attention to that. And on our point of view, what we're looking for is any trend down, and we just don't see it at this point. So this is our sectors. This week, I decided to rank them in order of performance for 2021. You can see the gas, oil, and energy is up 38.1%. We've talked about this ad nauseum. There's a reason why it had really gotten tanked in 2020. Financials is up there, relate that to housing. Basic material, relate that to housing. Industrials, technology, about where I forecast it. I've said before that we've talked about technology trying to repeat for an 8th year in a row. Don't think it's going to happen. So these are the sectors that we look at and what's going on. All of them are really decent numbers for the year as far as it being adjusted for an annual rate. I don't see any areas at this point that we're concerned about. We did pare back our information technology at the beginning of the year. Good decision. And I don't see us increasing it in the next probably 60 to 90 days. So world markets, this is where we get an indication of any kind of global recession going on. I pointed out earlier, my concern was the UK. They never did close down for Prince Philip's funeral. That ended up being kind of a non-event as far as the market's concerned. It's what he wanted. So you can see on the far right-hand side, year to date, the worst right now is, actually the worst right now is Hong Kong, and it's kind of tied with NASDAQ, which is our information technology group. And then the best is our own Dow Jones Industrial Average. Right behind that is our own S&P 500. The S&P 500 is the benchmark I typically use for my portfolio structure because it is some very diversified companies, and there's 500 in the group. You can see Japan's doing well. The only 3 areas that did poorly on the week were Hong Kong, Singapore, both Asia, and then NASDAQ. They got beat up a little bit on technologies this week. So that's how we're going. Again, if we're looking at the market going down, and I'm starting to hear, or I'm starting to read a lot of things about that in the media, I'm not paying too much attention to that. I try and read as much as I can, but we'll be looking for any trends and any indication the market's going to turn down. Right now, we just don't see it. So this is unemployment claims. Great week. You can look down and see that we actually dropped below 500,000, and we created about 1 million jobs. So things are going very positively on this. And you can see that May 6, 443,000, huge drop from the previous week. And this is really good news. I think our biggest problem is, and from what I hear, I said before, I had someone tell me they're having trouble hiring. I think that's going to start going away as the benefits decline and go away. We're starting to get some more hiring in travel and leisure. They're actually having trouble hiring people as well. They're looking for more employees. So that's absolutely really good news. So we need to blow past this one and go straight to our calendar. And this is what we're looking at this year, or this week. We will see non-farm payrolls. Mother's Day, I've reminded everybody, so you're out of luck. You got 48 hours to figure this out. Consumer Price Index and the federal budget come out next week. I have some forecasts on the federal budget. And if anybody thinks it's going to be in balance, let's have a conversation about it. It's not. Consumer sentiment's going to be a big report this coming week. Business inventories is going to be a big report. And then let's start to let you know ahead of time, you got Memorial Day holiday coming up on May 31st. That's a Monday. The market has normal hours on that Friday before. Mallory and I will be taking a break probably all of June and July, the way it looks now. We're going to have some vacations. We've got some pent up business travel and business training to do. And we're going to do a little bit of retooling on the program and be back the 1st of August, right before school starts. So get back to us with any questions you have. If you want to talk more about the inflation and core inflation, absolutely give us a call. I'd be happy to talk about it some more. Pay attention to what's going on in the market and watch. We'll be letting you know if we see any trends to the downside. But right now, we just feel really positive about where it's going. The Dow hit another high yesterday, which is just incredible news. So as long as we can stay positive, American consumers are kind of in control of their own destiny. So have a great week. We will see you 1 week from today, 8 o'clock Friday morning. Thanks for joining us. We really appreciate y'all being here. Take care.